Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on March 28th, 2022. Reminder, we have live trading tomorrow at 11. I'm going to review, as I always do, our trades and results from last week. I want to discuss a little bit. We've been changing tactics due to market conditions, and we're going to alter them a tiny bit again. And I want to discuss a trading of a core stock, in part because of emails going, why did we close, et cetera, et cetera. And we'll get into that right now. Last week, as you can see, we put on two new trades and we closed those two trades. We had really, really nice profits and we closed them early. And what I'll be discussing in a couple of minutes is sort of the numbers and the logic and the math of why we close early. And juxtaposed against current market conditions, there's little, if any, argument against why we should be doing so. One thing I want you to notice here is I don't have a copy of the alert in front of you, but when we sold this trade desk, the $61 put, the stock was trading closer to 70 and was more, the strike price was more than 10% out of the money. There's only a handful of stocks in our universe that we trade that can provide us this kind of distance in a 4-day trading period, meaning we were hoping this would expire worthless after 4 days. But the bottom line on this is that these kinds of what we call silly puts are something we can do going forward over and over again, in addition to trading our core stocks. And as you can see from here, we sold and closed Marvell. We rolled a core stock, Citigroup. We rolled a Bank of America position that had been hit when the bank sold off. And we put another put on a long-term position in Sunrun as solar energy sector has been moving. So as you know, the goal is 0.5% a week, which nets out to 26% a year. And last week, with the cash coming in from the new trades and the rolls, we way beyond that. The previous week, we're a little bit below. I think we were at 17. And I'm very pleased to say that despite what's been going on in the market, that cash rate of return, the annualized goals averaged since the beginning of the year are in the 30s. And we break it up so you can understand the new trades had a very high rate of return, the roll trades, and so forth and so on. So I hope you do some sort of tracking like this to show that while a portfolio may take a hit because of market conditions in Ukraine and COVID and China and the Fed, here you are every week grinding it out, generating cash, which means over longer periods of time, not just the 4-day period of a trade, you are really going to end up way ahead of your colleagues trading the market in a different way. Speaking of the market continues to be moved by three big things because we're not yet in earnings season. We're quite close, a couple of weeks away. One is Ukraine. Two is the Fed, the whisper, the rumor, and now Chairman Powell saying it's possible at the next meeting there would be a 0.5%, not 0.25 increase, and the China lockdowns. And let me walk through these 3 points. I had the great good fortune of being at a small gathering of 30 to 40 people on Saturday night, a group of people we get together 6, 5, 7 times a year to discuss usually a heady topic. The people who founded it, I and my wife are new for the last 3 or 4 years. The people who founded it 25 or 30 years ago, it's sort of in the Quaker tradition of all discourse is legit. You have to listen to it. So it's usually back and forth with some sort of an honored guest that's a specialist. Our honored guest on Saturday night was the ambassador of the Czech Republic to the United States. He was charming. He was articulate and extraordinarily experienced and knowledgeable. And what was most important, and this was an off-the-record discussion, but what was most important for us, we here, as people who think as investors looking at the market and the economy and also trade, is that the situation in Europe economically, because of the growing boycotts of everything Russian, and specifically Russian energy, is going to become significantly worse in the coming months and could last for a while, not just a few weeks or a couple of quarters. And to a lesser extent, the cutting off of Russia and Ukraine, and this also involves planting and harvest, their major grain exporters, could create significant issues in parts of the developing world. And he hammered the point home that there's a great deal of shared sacrifice. Americans and Europeans are feeling it at the pump, and so forth and so on, and it's not going away anytime soon. Even if you were sanguine in thinking that there'd be a ceasefire in the next 4, 6, or 8 weeks, he said the violation of physical territory means that it's really hard to, it's his opinion, that the sanctions are going to be lifted in any short period of time. So this is something that really impressed me about having an impact on our economy secondarily. Not just travel stocks, but things in doing business in Europe. So the Fed increased, the bond market responded very, very positively. The bond market did not sell off. The bond market was almost happy about it. Kind of a surprise technically, but it also says that, okay, we believe the Fed now. They're on top of this. And the China lockdown is partial. For example, Shanghai, which has either 23 or 26 million people, it's the largest city in China, had a half lockdown for one half the population over the weekend to get tested, and they'll be doing it again with the other half. But they took great pains to say that most, if not all, industrial centers and transit centers were still open because of obvious concerns about supply chain issues. But think of this backdrop. Interest rates in the US, to a lesser extent Europe, Ukraine, uncertain headlines, uncertain economic impact on Europe, the US, and the world, and China's supply chain issues, and yet the market has been pretty stable. That said, I'm not going to change some of the things that we have introduced in the last few weeks in the face of the uncertainty created by the Russian invasion. I will continue to occasionally use a good until canceled order. As you know, and I'll go through this in a second, I'm going to close trades rather than wait for expiration, even if it costs us a few pennies. I'm selling puts, as you saw with the trade desk and the Marvell puts, well out of the money. And I'm going to continue to roll our call positions, generating, as you saw in the numbers before, significant amounts of cash. Now, with trading frequency, I had gone down to 1 a week, and we were back up to 2 a week. I'm going to continue to be the norm. The norm has always been at least 2 a week. But please be aware, and this means keeping an eye on your email, if we close a position early, freeing up capital, I may put a new trade on via alert. Like when we closed Micron, we put it on a Tuesday, we closed it on a Wednesday. In today's market conditions, we might have put a completely new trade on Thursday or Friday. If the market shows the kind of stability we've seen, or if there's clear evidence of a run-up, I may just flat out put new trades on via alert, not in our Tuesday live sessions. And you're used to those alerts because we don't do live sessions 52 weeks a year. Now, as you can see, this gives us some latitude in that I can lower the rate of return, the target rate of return. But because I'm assuming we might close early, which actually pulls in the trade, frees up capital, that often, most always, increases the annualized rate of return. So in recent trades, for example, Trade Desk, Marvell, and Micron over the last few weeks, you can see the numbers. The original target return was 34 with Trade Desk, very volatile stock, extremely, which had been a silly put. I think the stock was at 69, we sold to 61, and we were down to 63 and change when I think we closed this. So we hit our minimum. We still had a 32% annualized return, which is the minimum that I like to look at. So we closed. Marvell Technology, and we have this is not the Marvell trade from last week, which I'll go into in a moment. So here, it's a core stock, so we trade it all the time. Here, you have a $69 strike and a potential annualized return of 48%. We closed it, again, after 3 days, not waiting for expiration in 4. And by the way, 3 days is really 2.5, but the day you trade in is considered one of the trading days. So it's Tuesday, Wednesday, Thursday. So we had a net profit of $29 per contract, and that's an annualized return of 51%. And then the last example is Micron. We closed that in 2 days, put it on a Tuesday, closed it on a Wednesday. So we were really in the trade for about 24 hours. But in fairness to the way Wall Street does its calculations, which is calendar days, this is how we calculate it. So this is going to continue. I put these in front of you. This is going to continue. I'm going, when possible, to close trades early because we really don't know, especially with Ukraine headlines, how the market's going to react to some news. So specifically, with Marvell, I want to walk through this and the logic both of putting on the trade and closing the trade because they actually go hand in hand. It's a core stock, a very diversified, broad spectrum chip and component manufacturer that has come to Wall Street's attention. Came to our attention a long time before that as a leading component supplier in the electrical vehicle market. So you can imagine how strong their book of business is. And they really, and this is because I do fundamentals, everything starts in the real world, not with a chart. That's like the last thing we look at. I do deep dives on everything that are recommended, and they have really terrific management. So this was the alert. As you know, in case you didn't do the trade, this is the alert. And you can see these are the numbers that I was showing, 0.5% in 4 days, 48% annualized, and so forth and so on. And but then we take a look at what we did. The trade itself was almost 5% out of the money for a very, very undervalued, growing, seriously double-digit growing chip and component supplier that had reached elevated status on Wall Street for a period of time because of its EV position. And so there was no definable support. This is what I wanted to focus on. Many of you like charts, you like implied volatility, you like all these fancy Greeks and all that sort of stuff. Well, in a volatile, jumpy market, what good is that going to do you unless you're trading in 20-minute increments? I prefer the real world. I prefer familiarity. I prefer understanding how a stock is trading. And it's not a quantifiable term, but to have a feel for a stock over a very short period of time. And so that's why it was very straightforward to put the trade on. The strike was almost 5% out of the money. And even though there was no definable support on the 20-day chart, I look at the 20 and the 90, this was a safe haven stock. The tech sector had become a safe haven place. Investors were beginning to buy bottoms, not traders. Traders are trading in and out, in and out, in and out. Every 2 hours, every 3 hours. Investors were going, chips are cheap. They still may go down, but chips are cheap. And so since this is a core stock, and I know we can roll it and generate a huge amount of cash, and I think it's radically undervalued, of course we made the trade. So then we closed it early. And what we did by closing early is we freed up capital, and we boosted our rate of return. It's roughly the same, 48.51, pretty close. But it was more than the 32% annualized. That's the minimum when we can get it. And we hit the original target. It's a wobbly market. I know I'm going to trade it again. And this is the reason I'm sort of deep diving this. People send emails, it's a core stock, why are we closing? We could always roll it if it runs south on us. In this kind of environment, this is the shift in tactics that I said we need to do. We need to go in and out more quickly and free up capital for other opportunities. This is, for those of you who didn't do the trade, or those of you who are new, this is what the alert looks like. And one point on the current option price and the recommendation to purchase. Some of you said I didn't want to pay the commissions. Well, most brokers that I know of, in fact, I can't think of one that doesn't do this. It's a free commission if you're buying something back for a nickel, and many now it's 10 cents. So please check with your broker and see if you have the best terms. So going forward, to wrap up, reminder, be ready to close positions early via alert rather than watch them expire. Be ready to put on new trades as we free up capital, as opportunities arise. As the market does this on our behalf, let's take advantage of what the market is giving us. And as you might guess, this all adds up. We're going to be nimble. We're going to be a little lighter on our feet than we were 6 months ago because the market is allowing us to do that and is demanding that we do it. And a last point, when you're trading your own, I'm assuming you trade or invest in other stocks. That's a fair assumption. Based on all the time I spent with you all in Florida or last year in Las Vegas, hitting predefined targets means that targets create discipline. They make it really straightforward, as you saw in my walking through these numbers, to close a trade, to not look over your shoulder, not to get greedy going, nope. Minimum is 32% annualized return. Bingo, I'm closing it because of the way the market is moving. I can open the position again in 2 days. And so separate that mentality from, I don't want to spend the cash. I don't want to give up the cash that someone's given me. Forget that thought. Stick with your goals and stick with the current value of the trade if you close it. This is Michael Schulman. Thanks for listening.